In this video, we're going to go over Learning Objective 3 and explain the accounting for long-term notes payable. The accounting for notes and bonds is quite similar. Notes, like bonds, are valued at the present value of their future cash flows, and then a company will amortize any discount or premium over the life of the note. Now, if a company issues a zero interest-bearing note, then the difference between the face amount of the note, the amount that they're going to pay back at maturity, and the present value, that is the cash they receive today, is recorded as a discount. And that entire discount is amortized to interest expense over the life of the note. Let's consider some other situations. We often will issue notes in exchange for plant, property, equipment, or goods or services. If we do exchange a note for goods or services in a bargain for transaction, the stated interest rate is presumed to be fair unless one of three conditions. No interest rate is stated. 2, the stated interest rate is unreasonable. Or 3, the face amount of the note is materially different from the current cash price for that item or similar items, or from the current fair value of the note itself. Now, if one of these conditions hold and we presume that the interest rate stated in the note is not fair, what do? The first thing we would do is try to determine the fair market value of the goods or services we've received. And if we can't do that, and the note has no ready market value, then we're going to have to approximate an applicable interest rate, or we're going to what we call impute an interest rate. So again, we try to look to the fair value of the underlying goods exchanged or the note exchanged, if possible. And if we can't determine those fair values, we're going to try to look to the prevailing interest rates for similar types of notes that the company might have issued or other companies with similar credit ratings might have issued. And we'll also want to consider factors such as restrictive covenants or collateral that might underlie that note, the note's payment schedule, what's the current prime interest rate. So there's lots of things we would have to look at to try to impute or approximate an interest rate on that note. Let's go ahead and take a look at some examples. Let's take a look at two examples. The Splish Company makes the following two acquisitions on January 1, 2020. It purchases land having a fair value of $220,000 by issuing a 4-year, zero interest-bearing promissory note in the face amount of $340,000. Let's take a look at the transaction, the journal entry for that. We know we record notes at their fair value, or rather at their face value, so we're going to record notes payable in the amount of $340,000. I guess also we record notes at their fair value. In other words, what did we get? Well, we know the fair value of this note is equal to the fair value of the land that we purchased. So the land is what we want to record at $220,000, its fair value, rather than the note's $340,000 face value. So basically what we're assuming is the note has a fair value of $220,000 because that's what we got in exchange for the note. And the difference between the fair value of the land and the face value of the note we record as a discount on our notes payable. Now, it doesn't have a stated interest rate. In fact, it says a zero interest bearing rate. And we really know there's no such thing, except perhaps today the rates are very low. But we're going to need to impute an interest rate. And we can do this using Excel's rate function. We have 4 for the number of periods, 0 for the payment because we're not making any periodic coupon payments. The present value of the note is going to be the $220,000 fair value of the land. And then the future value will be the face value of the note, the $340,000. We want to be sure that we enter the signs for the 220 and the 340 have opposite signs. One is, in essence, cash or value we are receiving, and the other one is cash or value that we are paying. For transaction number 2, we're told the company purchases equipment by issuing a 6% 8-year promissory note having a maturity value of $400,000 with interest payable annually. We're also told the company has to pay 12% interest for funds from its bank. So we can see that this 6% note or interest rate on the note is unreasonable, and we're going to have to impute an interest rate. Let's go ahead and take a look at our journal entry. First thing we're going to do is we record notes payable at its face value. Always record notes and bonds at their face value, and then we accompany them with a premium or a discount. Now we have to calculate the fair value of the cash flows, and we can do this by using Excel's present value function. We're going to enter 12% for the interest rate because that's the company's normal borrowing cost, 8 for the number of periods. We're going to enter an amount equal to $24,000 for the payment. That's the note's face value of $400,000 times the 6% stated interest rate. And then, of course, we'll enter $400,000 for the face value. Again, the payment and the future value both have to have the same sign, as these are being cash flows being paid out to the investor, the lender, or the bank. Again, since the note's interest rate, stated rate, is considered unreasonable, that's why we had to impute the cost of borrowing. Then we'll record the difference between the fair value of the note, what we consider the value of the equipment, the $280,770, and the note's face value or par value, I guess it's really face value, of $400,000. The difference between those two will be recorded as a discount on our notes payable. And again, 12% is the imputed interest rate on the note, and that was simply coming from the company's normal cost of borrowing. Let's go ahead and look at the journal entries that we need to record at the end of the first year on both notes using our effective interest rate method. On the land, we will record interest expense of $25,294. That's the 11.5% imputed interest rate multiplied by the $220,000 fair value. Don't type in 11.5%. Link to cell H24 because the 11.5% is a rounded number. Of course, the other half of our journal entry then is simply a $25,294 credit to the discount on the notes payable. In other words, we're increasing the liability by the amount of the interest expense that we're currently not paying. For the equipment, our interest expense for the first year is $33,693. This is our imputed interest rate, or cost of borrowing from the bank, of 12% times the fair value of the equipment, which we determined was $280,777. And again, in this case, we determined the imputed interest rate of 12%, not by looking at cash flows involved in the transaction or values involved in the transaction, but rather we relied on the cost of borrowing that the company would have to pay from the bank for a similar type of note. So our interest expense is $33,693. We are paying cash of $24,000. That's the stated value, stated rate of 6% times the face value of the note. And of course, the difference is credited to our discount on the notes payable. And over time, that liability will increase.